This video focuses on financial statement analysis of Adidas and Nike. To begin with, Adidas is a German multinational corporation headquarters in Bavaria that designs and manufactures shoes, clothing, and accessories. It is the largest sportswear manufacturer in Europe and the second largest in the world. The Adidas Group has Reebok Sportswear Company, TaylorMade Adidas Golf Company, 8.33% of Bayern Munich, and Runtastic, an Austrian fitness technology company. On November 1995, Adidas had its first initial public offering. The key executives of Adidas are Kasper Rosted, Ronald Aschel, Eric Lettig, Harm Allmar, and Sebastian Steffen. The key competitors of Adidas are Nike, Callaway Golf Company, Puma, Fila, Converse, New Balance, and K-Swiss. Next, introducing Nike, an American multinational company founded in 1964 by Bill Bowerman and Phil Knight. It began as a Blue Ribbon Sports headquarters in Beaverton, Oregon, United States. It produces footwear, apparel, equipment, and accessories. Nike markets its products under its own brand name as well as Nike Golf, Nike Pro, Nike Plus, Air Jordan, Nike Blazers, Air Force One, Nike Dunk, Air Max, Composite, Nike Skateboarding, and subsidiaries including Brand Jordan, Hurley International, and Converse. In addition to manufacturing sportswear and equipment, the company operates retail stores under the Nike Town name. In June 2015, Nike signed an 8-year deal with the NBA to become the official apparel supplier for the league beginning with 2017-18 season. Looking to the key competitors of Nike are Adidas, Reebok, Puma, Converse, New Balance, Under Armour, and K-Swiss. Now we'll look forward towards the key drivers of both the companies. Serving global customers, planned responsiveness, and in-season creation are the key drivers for Adidas. Growth in emerging market, women's product segment, and integrated marketplace to connect e-commerce and store sales are key drivers for Nike. Both the companies at the same time face challenges in the marketplace. For Adidas, market is becoming saturated quickly from more and more products on sale. It can help to raise money in short term, but in long term, it can damage the brand. Overseas manufacturing is increasing production lead time, but outsourcing production and technology is risky, and a less innovative approach can impact its growth in the future. Whereas challenges faced by Nike are frequent releases of new shoe models and release of vintage style has eroded the brand value of Jordan as they are being sold at a slower rate because basketball trends are slowing down. Plus, it faces intense monitoring competition from Adidas and Under Armour. Let's have a look towards some financial fun facts of both the companies. Nike, the famous swoosh logo "Just Do It" was created in 1971, 9 years before the company went public. As of 2017, the Nike brand is valued at $29.6 billion. Nike reported a solid third quarter delivering revenue growth of 5% to $8.4 billion. The gross margin declined 140 basis points to 44.5%. Earning per share increased 24% to $0.68. The effective tax rate for Q3 was 13.8% compared to 16.3% for the same period last year. Looking towards some financial fun facts of Adidas, the Three-Stripe Company had its first initial public offering in 1995, and Adidas brand value at present is $7.9 billion. Revenues increased by 12% on a currency-neutral basis in euro terms, 5.7 billion equivalents to $6.6 billion, and the gross margin has been raised to 50.4% due to more favorable pricing and product mix. Basic earning per share from continuing operation also went up 33% to $3.14. So, in the brand battleground, Nike wins. Next, we look towards the street position and expectations of both the companies. As on 18 November 2017, the current market value of Adidas is $109.43 and is expected to go high up till $134.72 and low down till $80. Analysts at this point of time highly recommends to put Adidas shares on hold. There are fluctuations in selling from last 3 months, including the current period, though the advice for buying is constant from last 3 months and even in the current period. The analyst consensus are overweighted. Looking towards estimated earning price target, the average price target on 18 November 2017 is $118.48. The current annual earning estimates is 3.89, which is more than last year, which was 2.60. The earning is estimated to increase for the next 2 years, reaching 5.51 in 2019. Adidas has 24 institutional shareholders with 3,82,526 total shares held. Moving forward towards Nike's street position and expectations as on 18 November 2017, the current market value is $59.19 and is expected to go high till $71 and low down till $41. Currently, the situation is a bit tricky as analyst buying recommendation is going down and the advice is to keep the shares on hold. There are no fluctuations in the consensus and they remain overweighted from last 3 months and the current period. Looking towards estimated earning price target, the average price target as on 18 November 2017 is $59.25 and the current annual earning estimate is 2.32, which is almost same as the previous year. It is expected that the estimated earnings will go a bit high till 2019 up to 3.12. Nike has 1,398 institutional shareholders with more than $1 billion of total shares held, which is a big number. Each company has its own way to segment their business. Adidas segments its business based on 4 major factors: demographic, psychographic, behavioral, and geographic. These segments are done based on age, gender, social caste, location, interests, etc. Adidas Group has many brands in its portfolio meant for different segment customer groups, in which the strong leading ones are Reebok, Adidas, Rockport, and TaylorMade. Nike segments its business based on 4 major categories: footwear, apparel, equipment, and its global brands. The footwear category generates the highest revenue to the company, and North America, its home country, contributes towards the highest revenue as compared to the other locations. Now we look towards an important topic: horizontal and vertical analysis. Focusing on horizontal analysis of balance sheet, Adidas current assets increased from 2015 to 2016 by 18.52%. There is 32.89% decrease in long-term debts, which is a sign to indicate that the company is growing and is no longer relying on its debt and is making payment to lower it. Whereas for Nike, there is an 84.71% increase in long-term debts, which explains us that Nike is depending on debt to grow their business. There is a huge decrease in the notes payable from 2015 to 2016, which have resulted in decrease of total current liabilities. Looking towards horizontal analysis of income statement, net income of Adidas has a major increase from 2015 to 2016 of about 59.35% due to improved strategies for marketing and selling the products. Coming to Nike, net income increased about 14.88% from 2015 to 2016. Considering the vertical analysis of balance sheet, we observe the property, plant and equipment of Nike has a huge rise from 2015 to 2016, which is due to increase in their constructions, whereas there is only slight increase in Adidas. There is a notable increase in the short-term investment and retained earnings of Nike as well. The current liabilities and assets are increased in Adidas. Looking forward towards vertical analysis of income statement, net income of both the companies Adidas and Nike increased from 2015 to 2016. There is a slight increment in the cost of sales of both the companies. The income before taxes of Adidas has a notable increment from 2015 to 2016. We have also carried out ratio analysis for both the companies. The gross profit margin for Adidas increased by 0.3 due to better pricing, product and channel mix, as well as lower input cost, whereas for Nike it increased by 0.2. We notice here that Adidas gross profit margin is high in both the years. The operating margin for Adidas increased by 1.47 and for Nike it increased by 0.27. The rise in operating income is higher than revenue, resulting increase in the ratio. The higher a company's operating margin, the better off the company is. Return on equity for Adidas increased by 5.28, whereas for Nike it increased by 2.3. Nike is high in both the years, concluding that Nike uses their money more efficiently to generate net income. Nike has higher return on invested capital in both the years, which indicates that Nike is good at utilizing capital than Adidas. Return on asset for Adidas increased by 2.21 and for Nike it increased by 1.2. Comparing the ROA and ROC ratios over the years, we see that Nike has maintained a steady pace whereas Adidas has been fluctuating. So in order to do this, Adidas should improve distribution and marketing in the US market and improve position in countries like China and Latin America where there is high growth. Fixed asset turnover ratio for Adidas decreased by 0.09, whereas for Nike it increased by 0.56. Comparing over years, Adidas has higher ratio than Nike, as Nike has construction in progress which may have resulted in the lower ratio. Total asset turnover ratio for Nike is high in both the years, indicating that Nike is generating more revenue per dollar of assets, which results to a better performance of the company. The inventory turnover ratio for Adidas decreased by 0.22, whereas for Nike it decreased by 0.20. Adidas has lower inventory turnover ratios and asset turnover ratios than Nike, and the gap has increased over time. To improve these ratios, we recommend that Adidas should control their cost and reduce stocking up for inventory by promoting their premium products. They should have also improved management of raw materials used to make the product. Current ratio for Adidas decreased by 0.09, whereas for Nike it increased by 0.28. Quick ratio for Adidas decreased by 0.05, whereas for Nike it increased by 0.15. Adidas has lower quick ratio and current ratio than Nike, which means that Adidas is lacking in paying the debts. We recommend that Adidas should reduce the cost of their products and improve distribution and marketing strategy. Adidas has a higher DSO, that means there are more clients, customers who are paying bills late. Adidas must control the days sales outstanding by collecting receivables faster, or else there may be an increase in bad debts for Adidas. Nike's EPS ratio increased as Nike has managed to expand its profitability, partly as a result of its above average growth rates in the key North America and Greater China markets, higher direct to customer sales, and partly due to internal operational activities. Let's learn about dew point analysis. It is the method of performance measurement in which assets are measured at their gross book value rather than at net book value to produce a higher return on equity. Return on equity is the product of net profit margin, asset turnover, and leverage. After analyzing, Adidas' return on equity is increasing due to the equity multiplier. A higher equity multiplier indicates that a company has been aggressive in financing its growth with debt, which is riskier. The return on equity defines how well a company uses investments to generate earning growth. Adidas' ROE is lower than Nike, even though its equity multiplier is higher. Thus, Adidas should increase its net income by reducing the cost of goods sold, which is increasing every year. Also, it should reduce its expenses. Another method of checking the output of a publicly traded manufacturing company to determine its likelihood of bankruptcy is Z-score analysis. When Z-score is less than 1.81, it is in the distress zone. When Z-score is higher than 2.99, it is in the safe zone. When Z-score is between 1.81 and 2.99, it is in the gray zone. If we see Nike's Z-score range over the past 10 years, minimum is 4.7 and maximum is 11.26. And Nike's trailing 12-month C-score till August 2017 is 7.55. Similarly, Adidas C-score range over the past 10 years, minimum is 1.15 and maximum is 5.11, and Adidas trailing 12 months ended in 2017 is 5.19. The above two ratios show that company has Z-score located in safe zones. However, Nike is more considered safe than Adidas. Nike has strong position especially in market value of equity by total liabilities. Moreover, Nike also has customer base which makes Nike have higher sales and profitability. So to conclude, as a creditor, there are few factors to be considered before lending money to any organization, like credit rating, financial standing, available collateral, management guarantees, bank relationship, profession profile of the organization, and knowledge of the market and competition. Comparing these two companies and the above factors has made us come to the decision to lend money to Nike. It has been seen that Adidas has emerged as a true competitor of Nike in the last few years, but there is still one thing that is undeniable, which is the revenue gap between the two companies. Since Nike has built up a share of almost 55% in the United States, which is a huge market as compared to Adidas that only accounts for 5% of the market. Nike has made attempts to break into Europe, where Adidas is mainly prominent, and shake its dominance. This is adding on to the fact that they own the United States, specifically basketball and tennis. Looking at the marketing perspective, advertising has always been Nike's forte, having the ability to rope in celebrities to endorse the brand. Nike is now the official apparel provider and merchandise for NBA's 2017-18 season, beating its competitor Adidas. The key growth driver of Nike is e-commerce. Adidas is trying to catch up to Nike in the e-commerce, but Nike is still leading in this field. Nike is a customer-focused company and has introduced Customer Direct Offense, a new company alignment that allows Nike to better serve the customers, focusing on one-to-one connection with them. Since Nike is the market leader with a 13% increase in shares since the beginning of the year, the competition from other companies like Adidas looks less threatening. One major difference between the two companies is that Nike has been stable when it comes to growth, revenue generation, and profitability, whereas Adidas has been unstable all these years. Although Adidas has done quite well in the past 2 years, but when we see the overall financial conditions of the two companies, Nike has impressed us more than Adidas. We would rather prefer to choose a company that has shown consistency than one which has been inconsistent over the years. From an investor's point of view, Nike remained larger than Adidas in terms of sale, profit, cash flow, and market capitalization. It is also worth noting that Adidas shares have outpaced its rival over the past years. We will have a quick overview of the important measures of liquidity and solvency for the two athletic companies. Nike's net cash compares quite favorably to Adidas' net cash. Equally impressive, Nike easily beats Adidas in terms of its cash flow generation capabilities and its ability to meet the near-term financial obligations. Importantly, Adidas remains in perfectly fine financial shape as well. If we evaluate multiples at which the market currently values Nike and Adidas shares, then Adidas is generally valued at a slightly premium rate to Nike across the matrix. However, it is also important to understand how each company is expected to grow in the years to come to make a fully informed decision. For example, the consensus among sell-side analysts expects Nike to grow its sales 5.9% this year and 6.5% in 2018, whereas Adidas is expected to see its sales rise 13% and 9.3% over the same period. Seen through this lens, Adidas shares should command something of a moderate premium to Nike due to its higher near-term growth rates. Nike is somewhat cheaper than the S&P 500's current PE ratio of 25.75 times earning. Looking towards competitive advantages, Nike's brand value in 2017 is more as compared to Adidas. The two companies implement a well-functioning sponsorship model in which they sign top athletes around the world. Seeing these icons compete at the highest levels of global athletics in Nike and Adidas gear creates a powerful aspirational effect. Both Nike and Adidas offer dividends yields of 1.28% and 1.02% respectively. So on a whole, these two companies' share price probably share commonalities. Thus, from investors' point of view, it seems to be a tie. Both seems to be strong enough to continue producing profits for their investors well into the foreseeable future. We hope that this video was informational. Thank you.